Breaking news: the global economy entered another turbulent phase on Friday as financial markets reacted strongly to fresh developments in Europe and Asia. In the United Kingdom, the banking sector faced a sharp blow after reports surfaced that the government is actively considering a windfall-style tax on bank profits derived from quantitative easing, QE, reserves. Analysts estimate the proposed measure could generate £20 billion in additional revenue for the Treasury, aimed at plugging fiscal gaps created by rising welfare costs and infrastructure spending. However, the announcement sent shockwave through London's financial district, immediately eroding confidence among investors and prompting a widespread sell-off in bank stocks. Within hours, the combined market capitalization of NatWest, Lloyds, and Barclays fell by £7 billion, erasing months of gains and rekindling fears of a credit crunch. Financial experts caution that such a tax could discourage banks from lending aggressively, tightening credit availability for both businesses and households at a time when the UK economy is already facing fragile consumer sentiment, persistent inflationary pressures, and sluggish productivity growth. Economists warn that reduced lending capacity might result in slower business investment, higher borrowing costs for small enterprises, and an overall cooling of domestic demand. The proposed measure comes against a backdrop of an already strained UK economy, which has endured years of fiscal uncertainty following Brexit, pandemic-related debt accumulation, and recent energy price shocks. Critics argue that targeting banks may appear politically attractive but risks undermining long-term financial stability. On the other hand, government officials defend the idea, insisting that extraordinary profits earned from holding central bank reserves during an era of near-zero interest rates must now contribute fairly to public finances, especially as ordinary citizens face cost-of-living crises. The debate has sharply divided policymakers, with some arguing that the move could restore public trust by making powerful institutions share the burden, while others fear it sends a wrong message to international investors about the UK's commitment to open market principles. Meanwhile, across continental Europe, Germany reported a startling rise in unemployment, crossing the symbolic threshold of 3 million job seekers for the first time in a decade. Economists attribute the surge to a combination of weakening global trade, declining demand for German exports, and structural shift within its manufacturing sector. The nation's vaunted automobile industry has been hit particularly hard, with layoffs accelerating as firms struggle to adapt to the costly transition from internal combustion engines to electric vehicles. Supply chain disruptions and elevated energy prices, stemming from Russia's protracted war in Ukraine, have further exacerbated industrial challenges. The rise in unemployment has not only triggered alarm among policymakers in Berlin, but has also raised concerns across the Eurozone, where Germany has long served as the economic anchor. A prolonged downturn in Europe's largest economy could spill over into neighboring markets, threatening the region's fragile recovery and placing additional pressure on the European Central Bank to adopt more accommodative monetary policies. Political leaders now face the delicate task of balancing fiscal discipline with urgent labor market interventions to prevent long-term joblessness from eroding social cohesion. In sharp contrast to Europe's struggles, India delivered an unexpected positive surprise, posting a robust 7.8% GDP growth rate for the second quarter of 2025, even as it grappled with fresh U.S. tariffs on key exports such as steel, textiles, and pharmaceuticals. The resilience of the Indian economy is being driven by strong domestic consumption, rapid expansion in the services sector, and sustained government investment in infrastructure. Technology and digital services exports have remained buoyant, cushioning the blow from tariff-related disruptions in traditional manufacturing exports. Financial analysts suggest that India's structural reforms, digital transformation, and rising middle-class spending power have positioned it as a standout performer in the global economy, especially at a time when Western economies are slowing and China faces its own real estate and debt challenges. International investors have taken note, with foreign direct investment inflows remaining steady and major multinationals expanding operations in Indian technology hubs. India's continued momentum is not without risks, however. Inflationary pressures, particularly in food prices, remain a challenge, and policymakers are carefully calibrating interest rate policy to balance growth with price stability. Moreover, trade tensions with the United States, if prolonged, could weigh on export competitiveness. Still, the latest figures have boosted optimism in New Delhi, where officials portray the growth numbers as evidence of India's ability to withstand external shocks and emerge as a global economic powerhouse. The contrast between Europe's weakening outlook and India's rapid expansion underscores the shifting balance of global economic power, with emerging markets increasingly driving growth while advanced economies face structural headwinds. Taken together, these developments highlight the divergent economic trajectories shaping today's global financial landscape. The UK is wrestling with contentious fiscal choices that could reshape its financial sector. Germany is battling its most serious employment crisis in years, and India is charting an impressive growth path despite external pressures. Investors, governments, and international institutions will now closely monitor how these economies adapt to their respective challenges, as their outcomes will play a decisive role in steering the direction of global trade, finance, and development in the months ahead.